What's up, everybody? My name is Joe Brown, and this is Heresy Financial. You know, a lot of people right now are looking at the stock market as pretty much the craziest place in the world that you could invest your money right now. And in fact, just on September 30th, we saw the end of the longest streak of risk-on behavior in 22 years. And that's measured by simply investors buying the dip. Not only that, but the fear-greed index has bordered in between fear and extreme fear for over a month now. Yet with all of this, the S&P 500 is still not even 4% off its all-time highs. And it is obvious that by price standards, if you look at price alone, stocks have never been this expensive. But as you know, prices do not tell the entire story. So in this video, we are going to look at stocks from multiple angles so that we can determine whether or not stocks are actually overpriced, and if so, why. Ready? Let's dive in. So obviously stocks are expensive right now. Prices are high when you're just looking at prices, but prices unfortunately do not communicate to us the information that we need. Now, if we had a stable money supply, then all of the information given to us in prices would be sufficient for us to make educated decisions about how to allocate our resources. But when the supply of money is manipulated and changed, that distorts the price signals that are being sent around the economy and doesn't give the right information that would help you make a decision, to the best information about what to do with your money. And so because of that, we have to look at this from a couple of different angles. So first, we're going to take a look at this from the standpoint of affordability. And the best way to compare the stock market is versus average pay. So if you look at your average American citizen and then look at the price of the stocks that make up the stock market, in this case, we're going to be using the S&P 500, it has never taken more hours of labor to invest in the S&P 500 as it does right now. Now, obviously, I know what I'm not saying. I know obviously you could take $1, open up a Robinhood account or any accounts they do fractional shares, and you can buy a fraction of a share of the S&P 500 ETF SPY, right? That's very easy. That's not what I'm talking about right now. What this means is that on average, asset prices have gone up a lot more than wages have. So 20 years ago, if you worked for a day for average pay and then invested that in the stock market, you'd get a much larger pool of the stock market percentage of the total pool of stocks than you would today if you worked for an entire day and then invested that into the S&P 500. So for the poor, or the person that's making average wages, it's getting harder and harder to invest, meaning it's harder to climb out of that hole. That hole is getting deeper. That wealth inequality is getting steeper. This is the result of markets becoming more controlled, more manipulated, less free. Now, the fact that investing in stocks, the affordability of investing in stocks is at an all-time high might come as a surprise given the next thing that we're going to look at. So what are we going to look at? The share of household wealth that is in stocks. Today, stocks make up more of a household's wealth, share of wealth, than they have in 70 years. This means that today, your average person has more of their total wealth in the stock market than they have in 70 years. And today, that share makes up just about half. So just for an example of what I'm talking about here, you've got a hypothetical person with $200,000 equity in their house. They also have $200,000 between their brokerage accounts and their 401k. So 50% of their wealth is in the stock market. So what are the implications of this? Well, do you remember, I think there was something that happened like 12 years ago where a lot of normal average people had a majority of their wealth in a certain asset class, had something to do with like a housing bubble or something. I don't know. The point is that when the average person has most of their wealth in something, that means most of the buying pressure or most of the ability for new money to come in is gone. That money's already there. There's not a lot of leftover dry powder to come in and save the day by buying. In fact, a more likely thing to happen at that point is that all the money that is already bought starts to sell. All right, now on to the next measurement. We're going to look at the S&P 500 versus gold. And so why are we doing this? Gold has maintained its purchasing power for thousands of years. When you look long term over any amount of time in the last couple thousand years, and you measure the price of something in gold, and that price of something something is something that can't get cheaper through technology, then the price of it measured in gold stays relatively stable. And of course, if something can get cheaper through technology, then the price goes down, meaning that gold over time maintains its purchasing power or slowly and steadily increases in purchasing power. So how do stocks look against gold? Well, clearly you can see here that they are far from the most expensive that they have ever been. But I need to talk about this bubble here that you're seeing in the middle. There was a massive stock market bubble in 99, 2000. We all know this, right? And so stocks were extremely high in terms of price. And at the same time, gold had just finished a very long period of time where it had been getting sold by central banks on net. So it was finishing out its bear market right in 99, 2000. And that was the turning point when central banks actually became net buyers of gold instead of net sellers. So 99, 2000, that was the end of the gold bear market, the beginning of a massive monster gold bull market that happened to be right at the same time as we had a big bubble in the stock market. So obviously you are going to see stocks look monstrously expensive compared to gold at that point. But outside of that extreme, the cost of stocks relative to the cost of gold right now is very high by historical standards. So why is this happening? Well, when you have loose monetary policy for decades, what it does is it expands the supply of money, which dilutes the purchasing power of all the existing money. That means if you want to store your wealth, you can't just throw cash under the mattress. Over time, you lose money that way. The number on the dollar bills will stay exactly the same, but the amount of stuff you can buy with it goes down. That's not a feature of things getting more expensive. That's a feature of your dollars losing purchasing power. So if your cash turns to trash by keeping it under the mattress, you're not going to do that. You're going to be forced to put your money into something that at least doesn't lose purchasing power. And as the speed of monetary debasement, purchasing power dilution accelerates, you are forcing society's wealth more and more into riskier and riskier assets to the point where most wealth now is going into the stock market just to keep pace with inflation. To the point that when, not if, but when this reverses, it will reverse hard. Now, one counterpoint to this. Just because stocks are expensive by many, if not all metrics, it doesn't necessarily mean sell and go to cash. Just look at what happened in Venezuela. There were plenty of investors who sold stocks as the stock market in Venezuela shot up and continued to accelerate higher, and stocks became wildly overvalued, only to watch the value of the cash that they chose to hold instead evaporate before their eyes. So maybe stocks go up 11% and the cost of living goes up 12%. You still lost purchasing power, but you did a heck of a lot better than you would have by just holding cash, which lost the full 12%. So hopefully this provides some insights for you. And also this should highlight the importance of being able to hedge so that you're protected from downsides while also not having to step out of the game and still have exposure to some of that upside. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.